To finance now, and a busy week ahead for investors and a tough week for households, with the cash rate forecast to rise to over 2% when the Reserve Bank meets on Tuesday. And as always, Scott Phillips, Chief Investment Officer at Motley, is with us to break it all down for us. Scott, good evening. We've heard earlier in our bulletin that this is the RBA's only weapon against inflation. If that's the case, why are they wielding it so much?
Peter, good evening. That is the $64 question, although it's much more expensive these days. The answer, of course, as we know and as we heard earlier, is inflation. At the end of the day, mate, if inflation gets away and stays strong for a very long time, then as painful as higher rates are, they would pale into insignificance compared to many, many years of very high inflation. So the RBA's view, and it is backed up by some sort of history, is that getting inflation under control now is less painful than letting it continue, despite the higher rates and the pain that is going to cause for Australian households.
OK, so the household side of the equation, people want to know when will the pain stop, when will the rate rises stop? And yeah, I suppose that's geared to your point that, well, I suppose when inflation starts to head downwards.
Unfortunately, that is and does seem the reality, Peter. Last time we had really high sustained inflation, of course, was the early 1980s, which is a very long time ago. But even then, and particularly most famously in the US, they kept raising rates even during a recession because they wanted to kill inflation off. Now, it actually worked. It pretty much put paid to inflation for a few decades. So that is what can happen if they get it right. It does seem, though, the RBA is very keen, as is the US Federal Reserve, to continue to raise rates as long as necessary, despite the pain it will cause. They're not blind to it. They know it's going to hurt. They're not doing it deliberately or they're not doing it callously. They simply believe, and I think reasonably, that is the least worst outcome, given two bad options they've got for them. Probably 0.5% this week, unfortunately. Maybe another couple of those, quite honestly, mate. 3 to 3.5 seems to be consensus. I'm sorry to be the bearer of bad news, but probably more to come, and probably by Christmas.
OK, let's move on then. We get some GDP data on Wednesday. Have we got any optimism around these figures?
Yeah, we really do. And this is the challenge for the RBA. We haven't talked about the two-speed economy for a while, Peter, but I do think that's kind of what we're seeing right now. We saw last week, retail sales numbers were incredibly strong, up 1.3% for a single month. Now, annualise that, you're well over 12%, of course, by definition. GDP is also likely to grow to an annualised rate somewhere north of 3.5%. And so you've got this challenge at an economy level where individual households are absolutely feeling the mortgage pain. On the flip side, prices continue to grow. Wages are hopefully on the way up. We know that unemployment is down, and it looks like the economy is coming back and really running quite strongly. That's the challenge for the RBA. Is we like growth, we like good economic news, but it does tend to create that inflation problem. So hopefully they can get this one right. But if the GDP numbers are as strong as expected, that's part of why, unfortunately, the RBA has had to move. OK, a pretty tough week for investors last week. Any bright spots this week? Unfortunately, we're probably going to start with another bad day, Peter. We know last Friday, so the Friday before the one just gone, the US market fell 3.4% in a single session. That's what pretty much crawled us for all of last week. Friday night just gone, down another 1%, unfortunately. Our future's likely to suggest about 1/3% down at least Monday morning our time. Hopefully, we might get better news later in the week, though. All right. Scott Phillips, Chief Investment Officer from Motley. As always, thank you for joining us on the Late News. My pleasure. Thank you, Peter.